New day, different direction. The markets wiped out all of yesterday's gains and then some on worries that strong economic data might jolt Federal Reserve policy and jitters about escalating tensions on the border between Ukraine and Russia. Despite low trading volume and little other news, all the major averages began lower and then sold off very sharply mid-session. The Dow at one point down as much as 180 points, ended about 140 lower. The Nasdaq down by 31 and the S&P 500 off by 18. While stocks slid, oil prices went along for the ride, ending at a fresh 6-month low. West Texas crude fell nearly $1 a barrel to finish at 97.38. Bob Pisani watched today's sell-off from his perch at the floor of the New York Stock Exchange and now takes a look at what drove trading to the downside.
Stocks were modestly weaker at the open, but then stocks dropped again midday and gold rallied on comments from the Polish foreign minister that Russian units were poised to pressure or invade Ukraine. Some of the damage may also have been technical. The S&P dropped below Friday's lows and is now at the lowest levels since April. But these concerns did not just surface today. The overall trend has been poor since the end of July over concerns in the Ukraine and Europe in general, as well as concerns about higher rates in the United States. Now, several U.S. stock sectors that have been weak for days were weak again today. For example, oil stocks have been weak all month. Dow components Exxon and Chevron were both down roughly 2% today. And another Dow component, IBM, has been down 5 out of the last 6 days. It was down another roughly 1.3% today. And financials have fared poorly. Goldman Sachs and JP Morgan both down more than 1% today. The bottom line, it's been a rough start to August, traditionally one of the weaker months of the year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And Hugh Johnson joins us now to discuss today's market action and ways you can protect your portfolio in a volatile stock market. Good to see you again, Hugh. Welcome back.
Nice to be with you.
Tyler named all the things that have been troubling the market, but you really think it comes down more to the Fed.
Yeah, I think, well, if you start this whole period when the market's arguably overvalued, and I think, common sense, Sue, suggests that that was the case. 30% move up last year, almost an 8% move up this year. Sooner or later, you've got to get a correction. Obviously, there needs to be an excuse for that. I think the excuse for that, and it's more than just an excuse, is the perception that the Federal Reserve's probably going to move up their timeline on when they're going to start to raise short-term interest rates, and that's just going to aggravate conditions. We started this period thinking the market's a little pricey or overvalued. You add that to the equation, and that's you put it all together, and that gets people running for the exits or starting to sell stocks in order to protect themselves in the event this correction turns out to be something more severe.
Let me get your reaction to two sort of counter thoughts, Hugh, if I might. One is that the market is unarguably or inarguably less overvalued now than it was 10 days or 2 weeks ago. That's number one. And number two is that if interest rates rise, as most people expect them to sometime next year, early, mid, whatever, they're rising for a good reason, not because there's a big flush of inflation coming that they need to catch. And, oh, by the way, a little inflation, Hugh, is often a good thing, isn't it?
Yeah, it sure is. I think you start the whole problem is that you start this period being a little bit overvalued. And so the question is, what's going to drive the stock market higher? And the answer is, in a rising interest rate environment, it's not going to be price-earnings multiples. So then you turn your focus on the economy and earnings, and you ask, how are earnings going to be this year and next? And you come up with growth rates of something in the order of, say, 2% maybe this year, maybe a little bit more, 5%, 6% next year. And you say, where's the beef? What is it that's going to drive the market? And you can't come up with anything. So you say to yourself, let's wait till things get a little bit cheaper or there's better opportunity, and that's exactly what's sort of unfolding. We're moving towards better opportunities in the market, but it's really that valuation concern.
All right, now if the volatility is going to continue, we tasked you with coming up with a couple of strategies to protect portfolios in this environment. What did you come up with, Hugh?
Well, number one is I think that whatever happens, the correction, ongoing correction, it's within the context of an ongoing bull market. So the first thing I would not do is reduce my allocation to stocks. In other words, keep a meaningful allocation to stocks unless you can't sleep at night. Then maybe you cut back a little bit, but keep a meaningful allocation to stocks. The second thing you do when times get tough is you emphasize large capitalization stocks. Stay away from mid and small capitalization stocks. They perform poorly during a correction or during a bear market. The third thing is that within the context of the stock part of your portfolio, build some defense by owning some safer sectors. At the top of that list would be healthcare. You can also add utilities and telecommunications, even though I don't like the sectors. And the final thing is look away to other markets around the world. I think you're seeing better performance from some emerging markets. That's another strategy. So these are all things you can do to keep a good allocation to equities, but build a little defense into your portfolio. Good idea right now.
Do you recommend, Hugh, that individual investors should have stop loss orders or stop losses in place?
You know, Tyler, most individual investors should not do that. And the reason I say that is because for myself or even individual investors, it's very hard to call short-term swings in the market. That's why I say most individual investors should ignore this correction, should ignore these short-term swings in the market, should back away from all of that kind of thing, short-term trading, and should maintain a meaningful allocation to equities and ride this out. Because in the long term, again, ongoing bull market, I think you're going to be just fine.
On that note, we'll leave it there, Hugh. Thank you very much. Hugh Johnson with Hugh Johnson Advisors.